Okay, in this session we are going to talk about international import, export, and trade documents that are utilized in an international transaction. And so what we're talking about here, which could be something like a sales transaction where you have a company from, say, the United States that's going to be purchasing products from perhaps a company in France, and or it could be a manufacturing situation where we want to have products built by a manufacturer in perhaps Singapore or China or whatever country, and then we're going to import those goods back into the United States. And so what we want to talk about are some of the documents that are involved in that type of an international transaction, be it sales or manufacturing or construction or whatever the case may be. And a lot of these documents are also utilized in domestic transactions, primarily for larger transactions because there are costs involved that really don't justify in a smaller type of a transaction. So I want to start off by talking about three basic categories of the documents that are utilized. This is on page 49. So first of all, we have what are called bills of exchange, which in plain language, that would be what you would call a check that you write on your bank account. So a bill of exchange is kind of the technical term for that. We have what we call a promissory note. A promissory note in plain language is essentially a document that is evidence of a debt and contains a promise to pay a specific amount at some specific point in future. Bills of exchange and promissory notes in some ways are very similar. Essentially, they are a document that is substituting for cash money. And we'll talk about some more specifics here in just a few minutes. So, bill of exchange, which would be like a check, promissory note, which would be a debt, a promise to pay. And then we have what's called a letter of credit. A letter of credit is essentially a document whereby one or more banks that are involved in an international sales transaction, well, it could be domestic as well, because they're utilized quite often domestically. But at any rate, it's a letter whereby one or more banks will guarantee payment for a contract. And essentially what that's doing is it's giving the parties a middle bank, so they're involved in the middle of the transaction, and therefore the bank will be guaranteeing payment so that the seller has assurances that the buyer is going to pay because the bank has provided proof that they have funds to be able to pay the contract. And then it's also used as a form of an intermediary, as we'll take a look at here as we work our way on. And then the final document is what is called a bill of lading. Bill of lading is a document that is issued by a shipping company. That could be a truck, like a semi-truck, or a container, or an ocean-going vessel, either a container ship or a bulk transport ship or liquid transport. In other words, an ocean-going ship, or it could be an airline if you're doing air freight, or a railroad, whatever kind of shipping carrier, means of transportation or mode of transportation. A bill of lading is the document that's issued by the shipping company when the products are given to them for transportation. So think of the truck driver when they pick up your goods from your business. The truck driver will issue you basically what amounts to a receipt that the truck driver has received the goods, and that is called a bill of lading. Very important document in shipping and sales transactions. So let's begin with bills of exchange, talk a little bit more about them. Next page over. So again, a bill of exchange, often called a draft or a bank draft, or what we call, just sort of everyday language, a check. Like here's a checkbook. And essentially, a bill of exchange, the idea is that instead of having to provide cash or back in the day, gold or silver or jewels, that there is a piece of paper that can be a substitute for cash or other commodities as a form of payment. And this has been around quite a long time. This actually goes back to the medieval time period when you had Templar Church. The Templars opened up banks, and essentially they would provide a written document that you could draw on your deposits when you went from one place to another. That way you didn't have to carry your gold and all your valuables around. So this is a very old concept. And so the idea of a draft, a bill of exchange, or a check is that it is, first of all, written, dated, and signed, and has an unconditional order. And what that means is, unconditional means you can't change it. Once it has been issued, you cannot change it. It is a guarantee of payment, unless both parties agree, of course, to cancel it. So basically, it's the idea that the person who is writing the check is directing their bank of deposit to pay a person or a company an unconditional, definite sum of money. So it's a specific amount, with payment to be made upon on demand, meaning that when the person who receives the check as payment takes it into their bank, it has to be paid right there on the spot. Or potentially a future date, although that normally is not a negotiable check. So essentially the idea is, this is in written order if I have a bank account where I'm ordering my bank to pay another person. Now that seems so simple, but you have to think through the background there. First of all, there has to be validity. In other words, you've got a piece of paper that may have $1 million on it. There has to be validity there. There has to be trust in both the person who has issued the bill of exchange, the check writer, and the banking institution that the amounts will be paid. So that's one of the problems in international transaction, and this is true also domestically. You are working with companies that you may not know. You may have never had dealings with them before, and you want to make sure before you ship whatever goods you're selling that you're going to get paid, or you want to be paid ahead of time. So if you're the seller, you have obviously this goal where you would love to have payment before you build the product or you ship the product, but on the buyer's side, you have the opposite. The buyer does not want to pay until they've either received the product and verified that the goods are what they ordered, that they're not damaged, that they're the right thing for what they put their order in, that they'll fit whatever. If it's a manufacturing situation, make sure the manufacturing components are up to spec. So you have this inherent tension between buyers and sellers. So a check is great because you don't have to provide cash, but the problem with the check, if you're the seller and you don't know the buyer, you get this written piece of paper for $1 million. What guarantee do you have that that check will be honored by the bank? What guarantee do you have that the buyer essentially is good for the check? And so obviously checks are used all the time. It's a standard procedure in business, but at some time or at some level, there's just not enough inherent validity or trust, so to speak, where a check will suffice as the means of payment. And that's where we start to get into letters of credit and promissory notes and other documents. So at the very basic level, we have cash, of course, but then a check or a bill of exchange would be sort of the next level. But it's not a guarantee of payment by any third party, and so typically a seller on a large transaction is going to want additional proof or guarantee of payment before they will either finalize the sales transaction or begin the manufacturing process. So that moves on to, well, for a couple other things here. First of all, forgot to highlight that. A check is negotiable. So a negotiable instrument right here. A negotiable instrument is a phrase that's used to denote or a document that can be traded. Negotiable meaning that I can take the document and sell it to another party, and then they can turn around and sell it to another party. In other words, it is, again, like cash in respect it can be used over and over again as a payment. And so when we say a negotiable instrument, we're talking about those type of documents that can be used in lieu of cash, and those documents themselves can also be traded. They can be sold from one party to the next and on down the line, potentially. Now there are various different kinds of negotiable instruments. So just like we'll use a bill of exchange, a check. So for example, I write a check, let's say I'm buying $1 million worth of tires from a tire manufacturing company for my tire store, or computers or cameras, whatever. So I write a check to the seller, let's say for $1 million. The seller now has that check. That check is a negotiable instrument, it's a piece of paper. The seller has options. The seller may take it to their bank and deposit into their own account, or the seller may, what's called endorse it, that is sign the back of the check and transfer it to another party. Perhaps the seller is doing a deal with another company, and so they just want to provide the check to the other company. And then that company, because it's a negotiable instrument, could endorse it over to another party. And this was a very common way, before we had electronics and electronic payments and all that, back in the days of sailing ships, you had documents that could be traded, and then the person who ultimately ended up with the document can either go get the cash, or the document may be for a cargo ship, and the cargo that is coming in on a ship in 6 months from now. So the negotiable instrument would be a piece of paper that may be the right to receive that cargo once the ship docks. And that may be traded by different merchants. So 6 months later, when the ship comes into port, perhaps it's the 5th person in a row that is now holding that negotiable instrument, and then they go pick up the cargo because it's proof that they have the right to receive the cargo. So long story short, a negotiable instrument is a term that refers to any type of document which is a substitute for cash money and can be traded or sold on the third-party market, essentially. So a check is just one form of those. Promissory notes are another form, as are bills of lading, or a bond issued by a corporation. A corporate bond may be a negotiable instrument as well. So any type of a document that can be sold or traded for goods is what we call a negotiable instrument. Okay, next we have promissory notes, so we're on page 51. A promissory note is like a check in that it is a piece of paper that is a guarantee of payment. But the difference is it is for what amounts to a debt. In other words, a promise to pay money in the future. A check is a promise to pay money on demand, that is right now. Promissory note looks a lot like a check. In other words, it may be a written paper about the same size as a check, but the difference is it's a promise to pay money in the future at some point. And again, it is potentially a negotiable instrument. So you may loan money to me, I issue you a promissory note, and I agree to pay the money back over a 5-year period. You can then sell that note to a third party, usually at a discount, so that you get your money back now, and then the third party would be able to collect on that debt. That happens all the time in the mortgage industry, where you may go get a loan for a bank loan for your house, and that loan may be sold over and over again on the open market. And that's done for cash flow purposes and various things. So a promissory note is different from a check in that it is a promise to pay a specific sum of money at some point in the future. And again, it's a substitute for cash as a negotiable instrument. Okay. So we're here on page 52. This is kind of what a promissory note looks like. So you see here, $10,000, 90 days after the above date, the undersigned jointly and severally promises to pay to the order of the Bank of the River in New York $10,000 with interest at a rate of 11%. So it's a promise to pay in the future. Whenever you get a bank loan for a car or a house or any other kind of loan, you will be signing a promissory note. Now you may not realize that it's all those papers you sign, but that's one of the components of getting a loan is a promissory note. Now this one's short and sweet. Sometimes promissory notes are 40 pages long, depending on the complexity of the transaction. All right. So, assignment and negotiation. I'm not going to spend too much time on this, but when we talk about the idea of a piece of paper being negotiable, the method that is done is called an assignment. So an assignment basically is a transfer of rights from one person to another. So like I talked about before, if I loaned you money, I'm the lender now, you issue me a promissory note promising to pay me the money in 5 years, I can then assign my rights under that note to somebody else. And then they could assign it and on down the line. So the process of assignment is transferring those negotiable instruments. And that usually is done in the form of a written document called an assignment of contract or assignment of note or an assignment of loan or whatever the case may be. All right, let's move on here. So a letter of credit. A letter of credit is sort of like a promissory note in a way, or a check. But the idea of a letter of credit is fundamentally different. It is essentially an instrument, meaning a written document, issued by a bank at the request of a customer. So I go into my bank, and I ask my bank, let's say it's US Bank, or Wells Fargo, or Deutsche Bank, or whatever. I go into my bank, and I ask for a letter of credit for, let's say like I'm Les Schwab Tires, I'm going to order $10 million worth of tires from Hankook Tires. Now the tire manufacturer doesn't know who Les Schwab is. Perhaps they've never done business before, so they don't want a check. They want proof from a bank that they'll get paid. So Les Schwab, as the tire company, will go in to their bank and they will ask for a $10 million letter of credit. And that letter of credit then is guaranteed a payment by the bank. That way the seller, the tire manufacturing company, knows that they're going to get paid from an international bank like Deutsche Bank or US Bank or whatever. So it is an agreement that obligates the issuer, that is the bank, to pay within a certain time period upon presentation of documents. So to put that in plain language, basically the letter says to the seller, we have received perhaps $10 million on deposit, or the customer has good credit so they don't have to have that much money on deposit. And so the idea is this tells the seller that when they produce documents that provide proof that they have shipped the products that have been ordered, then the bank will pay the seller. So this also solves the problem of kind of the chicken and the egg. The seller doesn't want to ship until the buyer has paid. The buyer doesn't want to pay until the seller has shipped the products. So the bank is acting as a bit of an intermediary here. So essentially what it's doing is the bank is saying to the seller, you need to provide various documents, and that will depend on the transaction, but typically it will require proof that the products have been provided to the shipping company, and a bill of lading has been issued as proof of that by the shipping company. So in other words, the goods have been loaded on the truck, and the truck driver has given a bill of lading as proof and a receipt that they received the goods. Usually the documents will also require that there any inspection reports or environmental reports or engineering reports that may be required accompany the letter of credit, along with a certificate of insurance for cargo damage, along with what's called a certificate of origin, which is a document that verifies the origin country of the product to be shipped, and that's done for tax, customs purposes, and tariffs. So these are the various documents, and we'll look at these in a little bit more detail in a moment, that must be provided. And once the bank receives those documents, the bank will release the money. So there are different types of letter of credits. Oh, first of all, so the function of a letter of credit, as I've talked about, is to substitute the credit of a recognized international bank for that of the buyer. That way the seller knows that they are going to get paid by the bank, and they don't have to worry about the seller making or the buyer making payment, because the bank is guaranteeing it. Now, in the real world, there's usually two banks involved. The buyer's bank, so if I'm buying tires from a Korean manufacturer, my bank here in the United States, US Bank, would be the issuing bank, and then the bank of the seller in Korea would be the confirming bank. So you may have two banks involved, which is even better, because now both banks are guaranteeing payment. So it's the idea is to have the banks be the intermediary. So basically you have three parties, perhaps four. First you have the buyer, which we call the account party. In other words, they're the ones with the account at the bank. They're buying the goods. You have the issuing bank, which would be the buyer's bank. So here in the United States, I actually bank with Columbia Bank. So it would be Columbia Bank that has issued the letter of credit that verifies I have money on deposit. And then the beneficiary. The beneficiary is who is entitled to receive the money from the bank. That's probably going to be the seller of the goods, although it is a negotiable instrument and can be transferred perhaps. All right. Other parties, additional banks. You may have another bank in the country of origin. So perhaps I start with Columbia Bank and then US Bank comes on along to guarantee payment if it's a big enough transaction. And then the confirming bank is the bank that receives a letter of credit, typically in the seller's country of origin, their own bank. So they confirm that the letter of credit is legitimate. Nowadays this is all done electronically, of course, but other banks may be involved. That's the point I'm making. All right, next slide. Different types of letters of credit. So first of all, we have what's called an irrevocable letter of credit. Irrevocable letter of credit. This is the most common type of letter of credit. And as the name states, it is irrevocable. So what that means is once the bank has issued the letter of credit with all of the conditions, the exact amount, the name of the beneficiary seller, the party, that letter of credit cannot be changed. Now it may have a time limit on it depending on the transaction, but during that time limit, that letter of credit is guaranteed payment. So what do I mean by that? So if I'm a buyer, and if I'm going to buy $1 million worth of laptops or something, laptop computers from a manufacturer, I have to go deposit perhaps, depending on my credit, $500,000 in order for a bank to issue a $1 million letter of credit, maybe more. If I don't have good credit, I may have to put the whole $1 million of cash on deposit with the bank. And when that occurs, they issue the irrevocable letter of credit, and at that point, that account is basically frozen. I can't touch that $1 million. It is there to guarantee payment on that letter of credit. And so if the seller produces the documents that are required, that money is going to be paid regardless. Now this could be a problem sometimes if we get into a dispute, if the buyer and the seller want to call off a contract or something, that can lead to problems. So, nevertheless, an irrevocable letter of credit is the primary type of letter of credit that is going to be seen in a transaction. If I'm a seller, I want the certainty and the security of an irrevocable letter of credit because that guarantees I will get paid. A revocable letter of credit is revocable by the issuing bank. That is, it may be terminated depending on certain conditions and how it's written. And these are not super common, but they do occur. So revocable, meaning it can be changed or modified. A seller typically doesn't like that as much because there's not a certainty of payment like there is with an irrevocable letter of credit. And then we have a confirmed letter of credit, and this is again where a second bank adds their endorsement to the credit that they will also make payment. And again, as from a seller standpoint, they like to have a confirmed irrevocable letter of credit because usually the confirming bank is the local bank for the seller's own bank. And that way they know their own bank is guaranteeing that payment in addition to the buyer's bank. So we're going to focus primarily on irrevocable letter of credits because those are the most common type you're going to see in an international sales transaction or a large domestic transaction. Okay, page 57. So as I talked about earlier, a letter of credit is going to have, along with the written statement from a bank, the requirement that certain documents be provided by the seller in order to get paid. So if I'm the seller, if we have a sales transaction, I receive an order from the buyer. As part of that order, the buyer provides an irrevocable letter of credit for the sales price. And in the letter of credit, it will basically have a list of the various documents that are required in order for the seller to get paid. So typically, these are what we're going to have. Number one is a certificate of origin. That is a document that is issued by a manufacturer or a component, assembly, whatever. Whoever made the product, or if it's agricultural, the farmer, or whoever is the manufacturer point of origin for whatever product it is. There are rules for certificates of origin on how they're issued depending on what country you're in. But one of the main ideas of a certificate of origin is it is a document that will provide the basis for, first of all, whether or not a product is subject to a tariff for import and export purposes. It's also used to determine if a product may be prohibited from importation because of the country of origin, and that'll depend on a political situation. So for example, some Cuban products cannot be imported into the US, or other products from certain other countries, and we'll talk about that next class. So the idea is a certificate of origin is going to verify the country of origin for tax purposes and for customs and regulatory purposes. Also, a certificate of origin is important for free trade areas. So for example, we have a free trade agreement with the country of Jordan here in the United States. And so in order to comply with the free trade agreement, you have to have a certificate of origin that the product was made in Jordan or whatever other country we have free trade agreement with. That way you don't have to pay tax. All right, you may require an export license and a health inspection certificate. An export license is permission from a governmental body, and this will depend on the type of product. Some products don't need an export license. Most consumer products that you use on an everyday basis that you buy at Safeway or whatever, those typically don't need specific license. But some products need a very specific license. So any kind of product that's going to be involved, perhaps it could lead to navigation or weapons purposes, is going to be regulated. Nuclear products like radiological products, which you might use in medical or dental or in mining for ground penetrating radar. Those potentially are regulated, especially anything that's nuclear. You have products that may have antiquities or artifacts that may be regulated and require a license. So things like that. And we'll talk more about licensing requirements next class. Next one is a certificate of inspection, and this will again depend on the type of transaction. A transaction may require an inspector to verify that the engineering standards are up to date, that the products meet whatever specific internal laws you have for consumer safety products, like Underwriters Laboratory here in the United States, or the CE certification in Europe, Conformité Européenne. So that kind of thing. A commercial invoice, which is issued by the seller as a demand for payment, and then the bill of lading, which is issued by the shipping company. And if it's going to be, depending on the type of transportation, it's going to go by ocean, a marine insurance policy for cargo insurance. That will pay for damage in the event that the ship goes down or the goods are lost at sea or during loading operations or whatever. So these are the typical type of documents. There may be additional documents that are required depending on the type of product. You may have a certificate of title if it's a motor vehicle, or other kind of things if it's a boat or aircraft, registration documents, owner's manuals and manuals for maintenance, logbooks for an aircraft or a ship, all those kinds of things that need to be turned over at the same time. Okay, so next we have a bill of lading. A bill of lading, again, is an instrument, so a written document that's issued by, well, here they put ocean carrier. It's not just involving maritime trade, okay? So any kind of, a carrier is a term we use in transportation law that refers to providing transportation for goods or people. So a carrier could be a ship, an aircraft, a truck, a train, a bus, whatever. So bill of lading is a document that's issued by the shipping company that's going to be carrying the goods, the cargo, and it has entered into a shipping contract with the parties for the transportation of the goods. All right, page 59. There are three fundamental purposes or functions of a bill of lading. I'll tell you right now, I have a test question on this slide right here. The question basically is, what are the three primary purposes of a bill of lading? So first of all, the bill of lading acts as a receipt for the goods that are being transported. So when I say receipt, that means that, let's say it's a semi-truck, the truck driver has counted the number of crates or boxes or pallets or pounds or however the measurement is, and verified the amount that has been loaded onto the truck. And so the truck driver or the load master on an airplane or the stevedore chief on a ship, whatever the case may be, will issue that receipt. So this, it'll basically say this is to verify that there were 25 cases of French red wine and cheese loaded onto the truck for transportation. Now, why is that important? Real world. If there is an accident, the truck gets into a crash, and the whole thing goes up in fire, that's how we know, for purposes of insurance coverage, for cargo insurance, how much was loaded. So that is the primary document that will serve as the legal document in the event of a claim for damaged or destroyed goods. And that's the first thing that a judge is going to look at is the bill of lading. Okay, how much was loaded on to the truck, trailer that was involved in the collision? I've had cases where the truck driver didn't count properly, and then you get into a whole dispute about that, but we won't get into those details. So, a receipt for the goods. Number 2 is evidence of a contract of carriage. So what that means is the bill of lading is going to set forth the terms of the transportation agreement. So how much per mile will the freight charge be? Are you going to have any fuel or other surcharges? What party will be paying for customs inspections, storage at a warehouse, the other types of costs that are involved with shipping a product, and some of those will involve what are called International Chamber of Commerce terms, or INCO terms, which we'll talk about in a different class. But basically, that is the contract of carriage. So how much is going to be paid, what's the time for delivery, where it will be picked up, where it will be delivered to, all of those details about the transportation of the cargo. And then finally, a bill of lading acts as a document of title. Now what that means is the bill of lading is proof of ownership for the cargo. And historically, again, before we ever had electronics back in the days of sailing ships, the bill of lading would be proof of who the ship captain is to deliver the cargo of goods on the ship once it reaches port. And again, that could be sold, and perhaps from one merchant to the next, to the next, to the next. So whoever shows up at port and provides the captain with their copy of the bill of lading that has been properly issued becomes the owner of the cargo. So that's what we mean by a document of title. That is to verify who has the legal right to receive the cargo that has been shipped. Now later on, in a different class, when we get to INCO terms, we're going to talk about when does title transfer from the point of shipping to the point of delivery to the buyer. And that will depend on the contract, when does the risk of loss transfer, and we'll get into that in a different class. So 3 very important functions of the bill of lading. It's a receipt for what was loaded. It is the contract or the proof of the transportation contract, and it is proof of ownership. That's why it's so important. And like I was just saying, next page over, a bill of lading as a document of title means or shows who is the rightful possessor of a bill of lading, has title, and is entitled to basically possess, use, and dispose of the goods, in other words, to obtain the goods. Okay. Next slide down. A couple different terms. First of all, we have what's called an onboard bill of lading. So an onboard bill of lading is essentially a bill of lading, a document where the shipping, loading, tie downs, securing the load, all of those components about shipping goods, and that'll depend on the situation, has occurred. So this is proof that the goods have been loaded perhaps onto a ship and properly stored, properly secured to the ship's deck, and they're ready to be transported. So that's called an onboard bill of lading, as opposed to an in-transit type bill of lading. The next bill of lading term that I want you to know is a claused bill of lading. This may also refer to a, well, basically what this is a bill of lading that has been marked up. So for example, let's say we had a situation where we had a truck driver that is sent to a warehouse to pick up 25 cases of hydraulic oil for use by tractors in farming activity. So 25 cases. The truck driver gets to the warehouse and there's only 24 cases available to put on the truck for whatever reason. The bill of lading, which was pre-printed by the truck driver's company dispatcher in the morning when they left, says 25 in typewritten print. But there's only 24. So the truck driver basically crosses out 25 and writes in 24 and initials it and dates it. The shipper also initials and dates it. So basically it's an amendment or a change, an edit, to a printed bill of lading. Now we call that a claused bill of lading because once there have been markups, especially on a pre-printed form, then that can destroy the validity of the bill of lading and its ability to be negotiated on down the stream of commerce. Oftentimes, a bank will not accept a claused bill of lading for payment unless it can be proven through other mechanisms. So it may have to be reissued to show 24 cases instead of 25, even though both parties marked it up. So that's what we mean by a bill of lading that has been marked up or edited, with notes, that kind of thing. All right. Next we have a straight bill of lading. Straight bill of lading is essentially a bill of lading that is non-negotiable. It's payable to only one party. It has not been marked up or claused. And that's our standard type of a bill of lading. Some bill of ladings may be negotiable, some may not be. Some are negotiable, some are non-negotiable. Again, negotiable means that that bill of lading could be sold, perhaps one or more 5 times over, and whoever has the bill of lading in hand when the cargo arrives becomes the owner. Okay, so let's take a look at there it is, okay. So page 65. This comes from the textbook, but it gives a pretty good idea about what a letter of credit might look like. So here we have an irrevocable letter of credit that was issued by Importers Bank in London. And it was issued, in this case, June 15th, 2002. The importer limited from London, England, that would be the buyer, have their bank issued this letter of credit for the beneficiary, which is the seller, Compañía de Exportes of Buenos Aires, Argentina. So this is the buyer, this is the buyer's bank that issued the irrevocable letter of credit, and this is the seller, the beneficiary, who will get paid on that letter of credit. So remember, in a letter of credit, it's going to have a list of documents that the seller must provide to their bank. In this case, it's the advising bank, which is Banco del Sur. So that would be the seller's bank in Argentina. So essentially what this letter of credit is telling the seller is, number one, they have to provide a signed invoice in 3 copies, certifying that the goods are in accordance with the order from the buyer. So an invoice times 3 in triplicate, a full set of clean on-board bills of lading. So clean means it's not marked up. On board means it has been loaded and certified by the shipping company that they have loaded the goods in whatever mode of transportation it will be. So bills of lading, invoices, insurance and certificate, plus 10% for marine and war risks. That's cargo insurance. So you would get from the insurance company what's called the declaration page, and that is a document that the insurance company will issue to verify that there is insurance that will cover damage or destruction to those goods while they're being transported. It's cargo insurance. Next, the shipper, the seller, is going to have to provide certificates of origin issued by the Chamber of Commerce in 3 copies, evidencing that the goods are from Argentine origin. That's what I talked about earlier. So that will be provided to verify that those goods are from Argentina for tariff purposes and for licensing and free trade purposes. So essentially what the seller is then going to do, the seller is going to load the product onto the ship. The shipping company is going to issue the bills of lading. They're going to issue an invoice. They're going to get insurance and certificate of origin. Once the seller has all of these documents, the seller will take those documents to their bank, the Banco del Sur right here, and the Banco del Sur will take those documents, and then the bank will transmit them to the issuing bank, Importer's Bank, who will then pay the money. And that way, the bank here will pay the money, and then they'll get reimbursed from Importer's Bank. So that's kind of how a letter of credit is formatted. Now let's look at a bill of lading. Page 64. All right, so bill of lading, this one, again, remember a bill of lading is title, proof of the transportation contract, the shipping contract, and a document of payment. So Seagoing Carrier Company is the shipper, the transportation company. The shipper, that is the seller, is International Sales Company, and we have the buyer there in Argentina. So this is going to be contract of carriage. So this is the ship, the La Plata, the voyage number 03W, Panamanian flag. The cargo is going to be loaded there in Seattle. So final destination, Buenos Aires, gross weight, what has been loaded. It's been put on board, 6 widgets. And then down below there, you see this is the shipping information and how much is going to be paid. And that will be issued by the shipping company once the cargo has been put on board and signed by the shipping company. And then that will be provided to the seller to take to their bank. And that will start the whole process. So that leads us to page 63, which is kind of a convoluted little flow chart, but I just want to kind of work our way through it here, because this is sort of a flow chart of how a sales transaction utilizing these documents might take place. All right, so first of all, number one, the buyer and the seller enter into a contract for the sale of goods. They agree on the terms, they agree on the price, they agree on shipping, and they also agree that the buyer is going to have a letter of credit issued to provide proof of payment. So they've entered into the contract. The buyer then, number two, goes to their bank, their local bank. So I'm here in the United States, I might go to Columbia Bank or US Bank. I will apply for my letter of credit. And that'll depend on my credit worthiness, how long I've been in business, etc. My bank then issues a letter of credit and transmits a copy of that to the seller's bank, the confirming or the advising bank. You may have more than one bank there. So at that point, the seller's bank notifies the seller that they have received the letter of credit, and the seller can go ahead then and deliver the goods, number 5, to the carrier, to the shipping company. The carrier then will issue a bill of lading, right here, back to the seller, The seller will then take that bill of lading, which is proof, again, that the goods have been loaded. It's a receipt by the shipping company that they've received the goods. The seller now has the bill of lading. They'll take it to their bank. The seller then gets paid by providing all of the documents that are required in the letter of credit. So the seller is going to take the bill of lading, the certificate of origin, the proof of insurance, and all of that to their own bank, at which point they get paid. Seller's happy. The goods are now on the ship heading to the final destination. At that point, the seller's bank will send it back to the buyer's bank. The buyer's bank will then provide it to the buyer, the bill of lading. That way the buyer can pick up the goods when they hit port. The bill of lading will then be presented to the carrier once they have arrived at their destination. The carrier will give the goods to the buyer, and the buyer then will repay their bank, depending on whatever agreement they have. And then that will be confirmed back to the seller's bank. So here's the idea again. It's really quite simple, really, is you have banks involved to verify documents, verify the items have been shipped, to provide proof and guarantee of payment between the parties, which obviously resolves disputes, and that helps to alleviate roadblocks in international trade, because now you have banks that are involved in providing that guarantee of payment. Otherwise you'd have a breakdown really at this level right here between the buyer and the seller, because the seller wants to get paid, but the buyer doesn't want to pay until they've received the goods. So the banks are acting as a form of an intermediary, along with just being a financial institution. They're acting sort of as a third-party intermediary facilitator to help facilitate that transaction. So again, letters of credit, bills of lading are used virtually almost every major international sales transaction and in large domestic transactions to help facilitate that flow. Now sometimes you'll hear about a credit problem. A few years back we had in the world economy a big credit collapse, and essentially what was happening is banks were refusing to issue letters of credit, and that affects shipping, because now the buyer can't get the letter of credit to give to the seller, so the seller just sits on the products. So sometimes you'll read about that, it kind of goes on behind the scenes, but that's what they're talking about when they say there's a liquidity problem in international credit markets. That's usually what they're referring to, is this is one facet of it. And again, most of this nowadays obviously is done electronically, but back in the day it was all paper records. But the same idea still applied. So for this segment, this is something you can write about. I have an essay about an international sales transaction. This is one of the things that you can discuss, that you'll use letters of credit, bills of lading, why letters of credit are used, what are the purposes of a letter of credit and a bill of lading, that kind of thing. It's a way, if you're a seller, you can protect yourself because you know you're going to get paid by your bank, and a buyer protects themselves as well because they know that the money won't be released until all of the documents have been presented and certified to be correct. Okay, so that's enough, end of this section.